Today, we're going to dive into a really powerful concept, one that traders believe shows them the hidden footprints of the Wall Street giants. We're talking about order blocks. So let's get right into it.
Welcome to AI Explains ICT. In this video, we're breaking down the core content from Month 4, Episode 3. And hey, you're probably going to want to grab a notebook for this one, because understanding order blocks, it's a total game changer.
So, let's start with the big question, right? How can we, as retail traders, possibly know what the huge institutions, what we call the smart money, are actually doing? Well, the thing is, they can't completely hide their moves. They leave clues, little footprints all over the chart.
So here's what we've got on tap. We'll start by finding that smart money footprint. Then we'll dissect the anatomy of an order block. From there, we'll build out a complete trading plan, step by step, look at a real-world case study on the dollar index, and wrap it all up with a final checklist for your trades.
All right, first up, the smart money footprint. This is all about finding that breadcrumb trail, that hard evidence that massive institutions leave behind right in the price action. They just can't hide those huge orders, and that, my friends, gives us our edge. You see, when these big players with incredibly deep pockets step into the market, their giant orders create these visible signatures on the chart. And these signatures, these footprints, are exactly what we call order blocks. They are the clearest sign you'll get that there's real institutional power behind a move.
Okay, so we know why we're on the hunt for these footprints. Now let's get into the nitty-gritty, the anatomy of an order block. This is where we learn exactly what to look for and, just as important, how to know if it's the real deal. Now, the definition from ICT is very, very precise. A bullish order block is the lowest down-closed candle that you find near a key support level. Simple as that. And just remember, everything we talk about for a bullish setup, you can just flip it upside down for a bearish one.
But, and this is a big but, just spotting a down candle isn't enough. The absolute key here is validation. An order block is only really confirmed when a later candle trades decisively through the high of that down candle. You can see it right here in the diagram. That powerful move up is the real signal that smart money has stepped in and is ready to push prices higher.
All right, so you can spot a validated order block. Fantastic! Now let's actually put it to work and build a complete trading plan around it. This is your step-by-step guide from the second you enter to the second you exit. Step 1, and this is honestly the hardest part for so many traders, is patience. Once an order block is validated and price is taken off, we do not chase it. We just sit on our hands and wait for price to retrace to come back to the top of that order block's body. And here it is, our entry zone. When price comes back to that order block, we are buying at what ICT calls internal range liquidity. The easiest way to think about it is this. You're getting into the market at a discount, a wholesale price, with the clear expectation that price is going to expand higher to seek out liquidity at more expensive retail prices.
And right here, this is probably the most important rule of all. You have to have your entire plan mapped out before you even think about clicking that buy button. You need to know your exact entry, your stop loss for protection, and your profit target all from the very beginning. No exceptions.
So here's that plan in detail. Your buy level is the open of that down candle, right at the top of the body. The mean threshold, which is just the 50% level of the body, is like your line in the sand. A really good setup shouldn't dip much below that. Your stop level goes just below the low of the whole candle to protect your capital if you're wrong. And finally, your profit target? We're aiming for an obvious old high, because we know that's where a big pool of buy stop orders is probably just sitting there waiting.
And this is where it all comes full circle. Our goal is to sell our long position to those traders whose buy stops are getting triggered just above that old high. This destination is called external range liquidity. We bought at internal range liquidity and we're selling at external range liquidity. That right there is the entire trading model. Okay, now we're going to add a really powerful strategic layer on top of all this, using a higher time frame bias. This is how you make sure you're swimming with the big institutional current instead of trying to fight against it. This table basically simplifies the whole idea. If the big trends on the monthly, weekly, and daily charts are all bullish, prices making higher highs and higher lows, then on our intraday charts we should only be looking to buy. We wait for a dip into a discount, find our bullish order block, and trade in sync with that dominant trend. It's really that simple. We completely ignore any and all sell signals.
Okay, theory is great and all, but let's see how this all comes together on an actual chart. We're going to walk through a really detailed case study on the dollar index, starting from the highest time frame all the way down to the entry.
We're starting way out here on the monthly chart. This gives us the big picture. You can see price trades down to a key support level, a down candle forms, and then bam, the very next candle trades through its high. That gives us our validated monthly order block and establishes our long-term bullish bias.
Now we get to zoom in. We drop down from the monthly to the weekly chart. Inside that big, broad monthly zone, we can pinpoint a much more precise weekly order block. This top-down analysis gives us a much cleaner, lower-risk area to focus on for our potential entry.
And finally, the entry. Dropping down to the daily chart, look at this. We see price trades perfectly down into our refined weekly level. It respects the order block, gives us multiple clean entry opportunities, and then begins that powerful expansion higher, aiming right for that external range liquidity we spotted on the higher timeframes. It's beautiful when it comes together.
Okay, let's wrap this all up and distill everything we've covered into a final set of rules. Think of this as your pre-flight checklist for trading high-probability order blocks.
So, before you take any trade, just quickly run through this list. First, is the higher time frame on your side? Is your order block actually validated? Are you entering at that internal range liquidity level? Is your stop placed correctly? Do you have a clear target at external range liquidity? And finally, did that first move away from the block show real power? If you can tick all these boxes, you've just stacked the odds significantly in your favor.
So the next time you look at a chart, don't just see a bunch of lines and bars. Look for the footprints. Ask yourself, where is the smart money placing its bets? If you found this breakdown helpful, do us a favor and like this video and subscribe for more. And if you have any questions at all, just drop them in the comments below and a real human will get back to you. Safe trading out there?